So good morning, everyone, and welcome to day 2 of our A2II 10-year anniversary conference. I hope you enjoyed the party as much as I did last night. And I have to say, besides working on the industry representation for our 20-year anniversary, I think we definitely also need to work a bit on the gender diversity on the dance floor. The men definitely have some catching up to do there, so hope to see you then in 10 years on the dance floor. So today will be the expert symposium part of the conference, so we're going to get a bit more technical than we did yesterday. And with that, I'd like to hand over to Hannah to get us started.
Good morning, everybody, and welcome back to the second day of the A2I anniversary conference. I hope everyone enjoyed the dinner and the dancing last night. I mean, having seen everyone on the dance floor, I think I can now understand how supporting the A2II means you don't age and you continue to look the same age 10 years later. I thought it was actually a fantastic first day, so thank you to all the moderators and the speakers on the panel. I think you really helped make it, as I say, a brilliant day and some really useful materials and things that have come out. And I think it also sets the scene for today, for us to go, as Anka said, a little bit deeper into the technical detail and really make the most out of the collective expertise we have with us in the room. We have a couple of people who actually weren't able to join yesterday, and also just to refresh and recap everyone's memories of what was discussed yesterday. I'm going to start by doing a quick recap of what was discussed and some of the key themes that emerged from the discussion. So the day started out actually with a couple of keynote speakers, Jonathan Dixon from the IIS, Secretary General, and Michael Craig, who's Director General at the German Ministry for Economic Development and Cooperation. So Jonathan spoke about the IIS's long-term and ongoing commitment to financial inclusion, and actually originally how this had been met with some sort of questioning the role of the IIS in this area, but now how it was recognized is a very important part of the supervisor's work, so not a competing supervisory objective, but actually an integral part of supervisors achieving their objectives in areas such as financial stability and consumer protection. Particularly as the A2II, it was also very good to hear about the IIS's ongoing long-term support for the A2II and the importance they see as us of their sort of implementation arm, I think is how he described it, in both financial inclusion and also capacity building. We also heard a little bit about the IIS's new strategic plan, which will actually be seeing them putting a much greater emphasis on implementation going forward and supporting supervisory processes, and in particular actually in the area of digital financial inclusion. And then we heard from Michael Craig from BMZ, and here he talked about the important role that insurance plays in achieving development objectives and the empowering role I think it plays just generally in people's lives. And he also spoke about the need for actually insurance supervisors, and not just to be technical experts, but also to be able to advocate for the importance of insurance as part of achieving greater financial inclusion. And I also liked, he provided a very good analogy about how having insurance is like getting immunized. So if you have the flu jab before a virus comes along, you're protected and you're resilient. In the same way, insurance can help sort of protect you in some ways against an unforeseen event. So we liked, that came up a few times later on. So that was a powerful image, I think. And then we had our first high-level panel, and this was chaired by Vicky Supporter, who is the IIS ExCo chair. And here we went more, I think, into the detail of the importance of insurance, how it helps to achieve the Sustainable Development Goals. And she also highlighted the considerable protection gap that remains, and I think in particular in areas such as infrastructure investment. We again talked a bit more about the SDGs and also the largely unrecognized role that insurance plays in helping meet these targets. And I think this is a theme that came up a few times, that we all sort of in the room here agree that insurance is important. However, that's still not quite sort of making it to the policy level. And that's maybe something I think we can all maybe take out of today and take forward together. We also agreed as a panel on the importance of good regulation and a supervisory environment. And we had another nice analogy here, actually, from Babak, sort of president of the Toronto Centre. And he talked about electricity. So when there is electricity and it's working well, you don't really notice it. But when there's no electricity, then you clearly have a big problem. So I thought that was a nice example of the importance of regulation and supervision. And then we also heard from the supervisor from Costa Rica about their focus on rural women being the main priority sort of financial inclusion. And again, I think drumming home the point that insurance is not maybe getting the recognition it deserves. He spoke about a paper that had been developed looking at, I think, the country's implementation of the SDGs. And he said within this sort of huge text, actually insurance was only mentioned very few times, sort of 6 or 7 times, in contrast to other things being mentioned sort of 120 times. So I thought that was quite powerful. Then we had a panel looking at 10 years of inclusive insurance regulation, sort of achievements and regulatory approach. And I think my colleague Huilin took on the challenge of trying to sum up 10 years of development in just 10 minutes. I'm biased, but I think she did a good job, and we also have our publication out there, which we released yesterday, which I'd encourage people to look at. But some of I think the key themes that came out here was that technology has great potential, and also how insurance supervisors are giving a greater focus now to the protection gap and also conduct of business. And this, I think, was also illustrated by the world map. And this is a map that we sort of collect up together as A2II. But we've been doing it for the last few years. And if you look back to 2009, you can see that just 6 countries had produced a regulatory framework designed at helping support greater financial inclusion. And then looking today, we actually have 48 different countries that have either implemented or in the process of working on a regulation specifically looking at financial inclusion. And then we heard some country examples, South Africa and the Philippines, some of the early microinsurance pioneers, about their experiences in implementing inclusive insurance regulations. And actually 2 things I particularly really liked from Lorenzo Chan from Pioneers sort of intervention. One, he talked about how there was a real business case in inclusive insurance, i.e. it's not just sort of, as a commercial provider, it's not just a social good, but he was saying from Pioneer, they've seen that there's a real business case there. And I like that, because I think too often still people question whether you can really sort of make money, should we say, by at the same time providing a very good service to low-income people. And then he also actually highlighted the important role that regulation and supervision has played in the growth of Pioneer. He said how sort of initially he just wanted the regulators to sort of stand out the way, but actually now it was recognized how important they were in actually helping Pioneer provide the goods, products and things it can in the market in the Philippines. And the panel also talked a little bit about some of the challenges that are being faced. So the pace of change, how the markets are changing quite fast, and the challenge of supervisors, regulators, and sort of keeping up with the pace of change. The challenge of new players in the markets, so fintechs, but also actually non-fintechs, just non-financial players coming into the insurance markets. And actually, I liked here how, I think it was Tandani from South Africa, shared the example from Singapore, so what the supervisor was doing in Singapore. So a good peer exchange, but without having the Singapore supervisor here, we had sort of the example coming out from how they were dealing with it, but how they're dealing with the licensing and supervising of sort of new fintech startups. And then the very final panel, we heard here from supervisors from Pakistan, Brazil, Namibia, and Kenya on their experiences in supervising inclusive insurance. And I think what we picked out here was actually the importance of the local sort of different market contexts. And even if the size and the scale of the market is very similar, it doesn't necessarily mean you actually get the same outcome in terms of sort of insurance market growth. And also I picked out sort of the importance of the dialogue with the industry and the role the insurance supervisor plays in making sure that the right sort of preconditions are actually in place, and possibly even sort of helping set up an insurance lottery, as I think we were hearing about in Brazil. We also heard, I think actually from most of the panelists, about the problem of informality. And this actually was both in terms of a large informal economy in the country, but then also as well as informal providers sort of operating in the market, and the challenge that provides for the supervisors. And again, I mean, we heard a very honest description, I think, from some of where the challenges lie, sort of motivating the industry. And I like the way Henny put it here, that sort of the regulators opening the door, but no guests. I think and then the government support for insurance legislation to pass, which I know in Namibia has been it's been a challenge for a long time. But again, the need for sort of policymaker, government support within the country. And then dealing with cultural barriers. I think it was mentioned again in Brazil that people don't like to talk about funerals or buy sort of funeral covers. It's sort of seen as unlucky. So some of the sort of the barriers and things that insurance in terms of its growth needs to come up against. And then from Kenya, I felt we heard quite a positive story of the growth of the market there and the importance of strong leadership from the insurance supervisor and also openness to innovation. And we heard about an innovation lab that's actually due to be launched there later this month. So that sort of, concludes my summary of what we were sort of covering yesterday, which really moves me on to the discussion we're going to have today, where we're going to look at in more depth at the impact of inclusive insurance regulation, as well as go into, I think, much more depth actually on some of the trends and the challenges. So, I look forward to the discussion we're going to have today, and I hand back to Anka to introduce the first panel.
Thank you, Hannah. So as Hannah mentioned, the first panel of the day is about a topic that many of us are grappling with and which was already touched upon yesterday, the impact of insurance regulation on developing responsible, inclusive insurance. Again, this electricity analogy, I think, says a lot about it, that you really don't notice it when it's there, but if it does break down, then it causes a big problem. So the panel that we'll hear just shortly will focus on two main questions and aspects. Firstly, how do we measure impact? So the question that came up yesterday. And also what some of the successful impact stories are that we have observed in different jurisdictions. And to lead the panel, we have Craig Thorburn, who's lead specialist at the World Bank. Craig has provided technical assistance and managed projects in a vast number of countries. And he's really seen the impact of insurance regulation firsthand. Craig was also involved in the establishment of the A2II, as you know from yesterday. And since then, he's also supported many of our activities and events. We always really enjoy working with you, Craig, so thanks so much for all your support. So if I could ask you and your panelists, Ching, Craig, Churchill, another Craig, and Anna to come up front.
Thank you very much, yes, and my esteemed team of experts. I did think that perhaps... yes, I'll need it later. Thank you. Let me just put this here for a moment. Yes, I did think that the most useful thing to do to start off with was to set my timer, because at the end of this will be the coffee break, and we want to make sure that we have the coffee break on time. Again, to thank the Access to Insurance Initiative for the invitation and for having a 10th birthday as well, which is great. That's probably the most important thing. And to thank in advance my panellists who, as I say, have all the expertise we need to make a good session. The only other thing is that we would like to be interactive, and so that means that, of course, we have plenty of other expertise in the room, and we hope to draw on that as well as we go along. The final expert in the room is sitting right there with the clicker, and maybe you could advance the slides by 2, let's say. I had this nice impactful first slide. See, it's got impact. That's the biggest picture of impact I could possibly find. And then on the next slide, I've got 3 pictures. And I'm going to start by talking to Craig Churchill about this, because he was the first person to have anything to do with anything in microinsurance, as far as I can tell. Craig Churchill, aside from having been at the ILO for I think 20 years or something like that, almost, so that's a tremendous achievement of its own, and what's more, still having a great time doing it. Also has his name on the front of a green book. And many of us will have copies of that green book. And much to my astonishment, Craig believes that I'm one of the people that's actually read it. But the other good thing about this green book is that when I go around and visit various countries around the world, quite a lot of them say, "Oh, that green book's fantastic. I'm so glad you did it," because we get confused between the two of us. So I've got the benefit of all of the effort that you've done there, Craig. But on top of that, I think when we first met, I was coming from the regulatory side, and I had a perspective in my mind about how regulation is a good thing, and Craig was trying to convince me that that's not always the case. And I think initially, as we were having conversations and you were trying to teach me the right way of thinking about things, I was probably a bit hard-headed, and no matter what you said, I still believed in my mind that regulation was perfect and everything was fine. Maybe I misinterpreted what you were telling me back then, and maybe things have changed now in the meantime. But I mean, I'd like to invite you, Craig, just to start off with giving us some thoughts on this idea about what the impact of regulation really is. Is regulation something that's a barrier to inclusive insurance? So in other words, the impact is negative and less regulation means it just goes away. Is there a positive impact, as we were talking about, in terms of the introduction? Is it a barrier? Is it a partnership? Or is there a role, as Henny touched on, that the policymakers and regulators can actually be leaders to encourage people to come along into this world?
So I wish there was a sort of short answer to that question, because it really, I guess the short answer is it depends, which is a bit of a cop-out. But I think there are certainly circumstances where regulation is a major barrier. Somebody said something yesterday about a wet signature. Did you catch that? It just sort of slipped through. Was it Lorenzo? Lorenzo. And the whole idea of this wet signature sort of cracks me up. I don't know if other people find it as funny as I do, but the signature has to be done with a pen, I guess, which makes it wet. I don't know why you had this thing about wet signatures. But that whole notion of a wet signature, or having a policy document, in paper that needs to be delivered to somebody's address. Some of those types of regulations just don't make sense in some of the types of products that we're talking about, some of the distribution models that we're talking about. And so in those circumstances, the regulations are certainly a barrier. So that part down there. I think a big piece of it is around distribution. So, who's allowed to sell insurance? And if it's only certain types of organizations that don't reach low-income markets, then again, it's a barrier. So I think that the big piece that needs to be done is to identify what those barriers are and then explore ways of sort of removing them. And it doesn't mean no regulation, so that certainly wouldn't be my recommendation, but trying to find, somebody used the analogy yesterday about this appropriate balance between a market development side and the prudential side, and striking that balance, I think, is the important piece. But the process of doing that, I think it needs to be done through dialogue. And I think one of the things that we've seen in a number of countries is that the regulators don't have enough conversation with industry to be able to understand what the obstacles are, to be able to then figure out solutions for overcoming them. And I think there's issues certainly on the supply side, the insurer side, where they basically want to try to get rid of any regulations that might impede them. And so I think having constructive conversations about what makes sense and both parties being able to understand each other's perspective is an important part of that process. So that's where I would like to gear the conversation toward.
But if we go down the road that perhaps, so that's more this middle point of the conversation. So you're less of a subscriber to the view that regulators perhaps could be the promoters, let's say, or the leaders of the push. You'd prefer to say, look, the industry really has enough scope to move, and so it's a matter of just working with them to do that.
Yeah, it depends on the market development, or the stage where the market is. So there's a number, I've seen countries where insurers sort of say, oh, we're just waiting for the regulations. And for me, that's, they're saying, well, we don't really want to do it, is sort of another way of answering that question. In which case, having leadership from the regulator would be necessary to sort of get them going. Other markets, the insurers are actively out there trying to figure out how to innovate and how to serve unserved markets. And in which case, the regulators could be enablers of that, but the insurers are already out there doing it. And so it really depends on where the market is and how active the insurers are in trying to serve these unserved market segments.
So that then leaves me a little bit confused about how you might resolve the question of what the impact of regulation is if you're looking for a positive impact. And I know you've sort of been involved in some recent studies that have attempted to do this. What's the sort of key takeaway of that?
Yeah, so I think people asked yesterday, what would you measure as impact? And so the ideal scenario would be to do a randomized controlled trial where you apply regulations to some companies but not others in a sort of random basis. But you can't do that, right? You can't randomly change the regulations for some companies. So what you need to be able to do is sort of make changes and then see what happens as a result of those changes, but we don't know whether there's really causality. So you see what changes occur about the same time, and then have conversations with the insurers to understand what's the justification, what's the explanation for those changes. I mean, in terms of the indicators, the things that we like to measure are the number of people that are covered. That's a pretty straightforward one. So that's the volume one. And then looking at whether products ranges change. So is it just credit life insurance, or are they starting to introduce other types of product lines? Another piece would be new distribution channels that are getting involved. So is it just MFIs or just banks that are distributing insurance, or are there other channels that start to get involved? So that would be another sort of measure. And a key piece of it is also the quality. What is the value, the consumer value, customer value? And sort of a shorthand answer for that would be, what are the claims ratios, and are those changing as well? And are they seen as high enough to justify the value proposition for consumers? And so looking at those types of indicators and how they may have changed after regulations have been put in place, and then sort of validating that with conversations with insurers to see whether they indeed changed their behavior as a result of the regulations or not.
We did a sort of a similar kind of exercise where we were looking to see how projects that we've done over the years have contributed to market development. And we got a long list of projects, and we looked at those kind of developmental measures for insurance markets, and then we tried to look for correlations in some wonderful regression exercise that, like, typical actuarial thing to do. And all that did was cause us to think, well, that wasn't very conclusive. And I think one of the reasons for that is that sometimes things happen without a World Bank project. Maybe it was someone else's project, maybe people were doing things on their own initiative. And equally, sometimes we do projects well, sometimes we don't do it so well. So it's kind of really difficult to get to the finer points and distill things. Maybe we'll come back to that question of what the right measurements are. Thanks, Craig. So Ching is from Malaysia, Bank Negara, and if you've ever been to Bank Negara, you'll know that they have a headquarters building, and then they have a really fantastic building they constructed next door, which is occupied by all sorts of agencies and organisations, including those interested in financial inclusion, and absolutely tremendous facility. And so out of the wisdom of making use of that building, they've become a centre of excellence and great interest. She also has the title of development in terms of the department that she's leading. But I should warn you, she's been at Bank Negara for almost as long as I've been at the World Bank, but only in insurance more recently, which means that she has a fresh perspective and will probably cause us all to think totally differently. So maybe you could start off by just giving us a few clues about what you've been doing, which I know is a very interesting thing that a lot of people want to know about.
So good morning, everyone. Yes, so I'm actually from the Insurance Development Department, IDD, in Central Bank of Malaysia. So Central Bank of Malaysia regulates banking and insurance sectors. So Insurance Development Department is actually new. It was only formed about 3 years ago. Hui Lin, in fact, used to be in the department, and then, of course, she came to A2II to do greater global growth, greater global good. So insurance development, so why do we set up Insurance Development Department? We have departments that does prudential regulation, we've got insurance supervision. So the reason is really to give focus on development, because we're at a stage, like Craig says, we're at a stage where there's lots of interested parties who want to do insurance development, who wants to offer new products, innovation. But sometimes regulations take too long, and supervision takes a while for things to come out. So the real reason why the department was set up to give focus, and the mandate of the central bank really is towards promoting monetary policy and financial stability, as well as ensuring a sound and progressive financial sector. So development is clearly in our mandate, but at the end of the day, it is to achieve sustainable economic growth. And so that's how we are set up. And it means that we have to go through the difficult task of a balancing between financial stability, monetary policy, as well as financial sector development. So we see it more as an enabler. So I get to do the fun stuff. I get to say yes, yes, yes to all the industry guys. So I met a lot of them over the last 1.5 years. Before that, I was doing macroprudential regulations, financial stability, totally about risk. No, no, no. So now I get to be the fun guys, yeah. So so a lot of work has been put in place in the central bank on micro-insurance or inclusive insurance. It is also the term that we are trying to use now. And started off with the Central Bank Act being reformed after 50 years. This is our 60th anniversary. Another 50 years more to go for A2II. And then, of course, then in 2011, it was made specific in our roadmap for the financial sector that micro-insurance and micro-takaful should be key in our development agenda. Thereafter, fast forward, we've put together some micro-insurance regulations. And it's actually not done through yet an official policy document, which we are trying to put in place this year. But it culminated in a few things, with which I'm going to show. There are a couple of key initiatives that we have achieved. And this is one of the things that we've been trying to put in place, which is Pelindungan Tenang. So the logo is over there on the top. In in English, it literally means protection calm. So I think Hui Lin has sweat blood and tears over this project. So if you have any difficult questions about this, please, you can ask her. So thank you, Hui Lin. And really, it's to try to, I would say, stimulate or encourage introduction of microinsurance products. At that time, it was basically to come up with a framework so that the industry can know what to do when they want to introduce microinsurance products. I would say that all the principles of this framework is probably what a lot of you have in your countries. You know, the products needs to be affordable, accessible, easy to understand, easy to buy and claim, create a positive experience, and then good value. Easy on paper, but at the end of the day, when implementation comes, it's difficult because these are all, sometimes they could be conflicting, also with between regulations as well as what the consumer wants and also what the companies wants. So that's Tenang. And the other one is My Salam, which was just launched in January this year. This is actually a national B40. B40 is the lower income segment, basically the bottom 40% of income earners. And this is a public-private sector partnership. So we are basically giving coverage, takaful coverage, for these lower income group against critical illness and hospitalization. This is also another challenge. Why do this? I mean, we see the gap in the protection gaps when we talk to NGOs, we talk to industry, we talk to consumer groups, and apart from death benefit as well as basically employment benefits, we see some gaps in the medical and health segment. And so we said if the government wants to go into this, this could be an area. So it's also just started off. Take-up rates, claims ratios are still quite good, but main reason is because awareness is really what we're trying to go into, because we realize that at the end of the day, when you put supply, demand is also just as important, and awareness is really just as important. You can give free insurance or at a very low value, but are people even aware that they actually can claim on it? So I'm just going to leave it there.
Yeah, so, but this is an interesting example, if you go back to my sort of like the three things I was talking to Craig about, that really Bank Negara is leading in terms of this initiative rather than just either removing barriers or allowing people to do their thing in a market that, you know, you have plenty of insurers already.
Yes, with too many. There are about 50 of them. We have 30
Right,
million
yes.
population. Yeah.
So, so what brought you to the position that said, you know, we really want to take the initiative and lead here, rather than just encourage others to do something?
I think there was just no one really doing it, even though so most of the insurers were just catering to the middle and the higher income groups. So the lower income, there was just no one doing it. So I mean, I wasn't the pioneer for Tenang initiative, but I would say that without regulations, it would not happen. So I see it more as it was to create a momentum, even creating awareness among insurers as well as the consumers and also the government agencies or national agencies that we work with, that actually it's possible to introduce microinsurance products. Maybe we need to work it out, how best to do it, but is to say that it can be done, because no one would believe that it can be introduced at such low value. So like Pelindungan Tenang can be as low as almost $2 to $5 a month. And I mean, to me, I'm okay, so I'm not in that income group. So to me, it's like insurance can never be that cheap. Does it even work? So I think it was really to create that, and then collection of data. I think the role of the regulator by introducing these projects can actually help in collecting data that could be useful for the future.
And that's an interesting point in itself, because sometimes we think that the role of regulators is to produce regulations, but sometimes it's actually filling in part of this actual infrastructure of making things work. That is a different. You don't need a regulation to have a database necessarily. So, yeah. Dr. Anna Gonzalez is from Cambridge, and she's working with the Institute for Sustainability Leadership. And we have had sustainability mentioned yesterday. You weren't here for that, but well, I can promise you we talked about it a lot. So that's good news. And she's also been doing some analysis of looking for the impact of microinsurance, particularly with respect to the SDGs, which are on the next slide, I think, if we advance them one. So everybody who's not familiar with the SDGs, they come in this nice kindergarten-friendly kind of coloured map, and it's useful that perhaps Dr. Eva, if you could give us a bit of an update on where you are, because I know you've just produced a publication and discussed it with probably half the people in this room, but not with the other half.
Okay. Well, thank you, Craig, and thank you so much, Hannah and the team, for inviting me to take part in this panel. The work of the A2II has been a huge pillar to us in Cambridge on the trajectory that we have been following in the last few years. So I am just a great admirer of your work, and it's just a tremendous honor to be able to be here with you all today. And also this room is filled of friends, colleagues, husband, passionate about fighting poverty through access to insurance. And many of you have contributed significantly and in a very constructive, transformative way to the work that we have been doing as well. So thank you so much. And So just for us, and yes, Craig, in the context of the SDGs, our work in this insurance regulation space started in about 2014, when we produced, at the time when not many people were linking insurance and the Sustainable Development Goals. So we produced a study on how specifically insurance regulation should be a policy tool to help development and therefore the achievement of the Sustainable Development Goals. We continue to work in this space, and I am humbled today here in the presence of so many people who are doing such huge initiatives now in insurance and the Sustainable Development Goals. As particularly, the latest work we have been doing has been specifically on mutual microinsurance. And we think that we try to contribute to help filling in the gap that there is in a lack of impact assessments on the role of mutual microinsurance in communities, but then also to inform regulators. We worked in the Philippines as a case study, and in particular with an organization that many of you know well, Craig, Michael, you've worked with them before, CARD MBA. And so I'll speak a little bit more about them in a minute. One piece of data for us, just very striking, was how the A2II identified that community-based organizations outnumber commercial insurers in size, not in capacity, obviously, in market size. But there is not much knowledge about them. And mutuals represent 30% of the global industry by premium volume. But in many jurisdictions around the world, mutual microinsurers operate at this community level in the informal sector and not recognized by regulation. It has been calculated that 63% of low-income countries and 43% of lower middle-income countries do not have a mutual and cooperative insurance regulation. And so therefore, these community organizations operate mostly in the informal sector, which jeopardizes customer protection and insurance coverage. And let's just go back to that detail that they actually, in pure numbers, they outnumber commercial insurance. The richness amongst communities to protect themselves and to be self-sufficient is truly admirable. Now, our study developed in these two completely related themes. So the lack of knowledge on the impact that these products have truly at the community level, and the lack of regulatory recognition. So we try to address questions like, how does a successful mutual microinsurer operate and how it can achieve scale? What makes a regulatory environment supportive? What difference does mutual microinsurance make for households? And specifically, how does that impact on the Sustainable Development Goals? And are the impacts sufficient for regulators and for donors to support these community-owned organizations more extensively? I would like to share with you just a slide that belongs to, oh, thank you. Yes, so a bit difficult to see. This is very difficult to see. This is in our report, and you can check it online in an easier way. And a lot of work has actually gone into, first of all, just understanding this link between policy, regulation, law, and of course, always based on the impact that this has on the policyholders. So the Philippine case study is particularly interesting to us because The national development plans in the Philippines have traditionally been aligned first with the Millennium Development Goals, which are the predecessors to the Sustainable Development Goals. And these global frameworks on fighting poverty, they created poverty reduction policies at a national level that eventually were translated into targets for insurance coverage and for microinsurance regulation. We think microinsurance regulation, formalization of these community-owned organizations took place in around 2006 for mutual microinsurance, mutual benefit associations. So this is a very specific and this is a very just special part of Filipino regulation, the particular just space that created for these community-owned organizations. They were subsequently reinforced by a new law, the one there at the center, and providing a stronger framework for further regulatory enhancements to support the market and covering elements of governance, prudential management, supervisory capacity, and all still under further evolution and now completely linked as well to the Sustainable Development Goals as microinsurance and in particular this community-owned products as part of achieving those targets of development and fighting poverty. Just very quickly, the next slide shows the organization we were working with, CARD MBA. The progress that it has, it covers now about so over 5 million people, which is almost 20 million beneficiaries. And if you see in the first few years, it was struggling to achieve numbers and steady progress. As when between 2005 and 2006, when regulation was introduced, and many of you know the founder of this organization, Dr. Ari Salib, who was who very much contributed in the process of the need to introduce formalization for this organization and for these products for mutual microinsurance to be able to grow. So between 2005 and 2006, after the introduction of regulations in combination with other circumstances, the growth, as you can see, has been really impressive. Then, just finally, in the impact assessment that we have carried out, so as I mentioned just a moment ago, the real objective of the impact assessment was how do these products impact on the Sustainable Development Goals, and are those impacts sufficient enough for these for community-owned organizations to be supported further by and more extensively by regulators and donors. So we developed this impact assessment based on a review of 3 areas. So we review existing impact assessments in microinsurance, of which many of you in the room have worked very hard over the years, the ILO, the Microinsurance Network, the Microinsurance Center. So we took knowledge from those, mixed with the Sustainable Development Goals framework, and we applied as well the IAIS pillars for mutual insurance, explained in the 2017 application paper that Peter here led. We divided our impact assessment in 3 parts. One is what difference does this type of microinsurance make to communities after disaster happens. In this case, it was Typhoon Haiyan 5 years ago that devastated many parts of the Philippines in a colossal way. The second part, we analyze what difference does it make on a daily basis, and in the context of the Sustainable Development Goals. And finally, what specifically is to measure on these community special features of mutual microinsurance. And then we mapped out all these results across 10 SDGs. We interviewed about 300 households, 125 questions each. We had a huge volume of data to process and to quantify. And we then mapped out those results by the Sustainable Development Goals, and we obtained information on how these products contribute to development, and hopefully in the course of the conversation we can just go in more into that.
So, well, one of the questions in my mind when I was reading your material was that perhaps historically, when we've thought about the impact of microinsurance, we've thought about the impact on the eventual impact on customers, what benefit customers might have from having microinsurance or not. So in one sense, in the middle, you've categorised that impact from the study to then look at the development goals themselves and sort of express them in terms of contribution to the development goal as well.
Exactly.
Right. Well, I think an interesting question then arises, and perhaps I'll ask someone who perhaps would be surprised if I asked them this, but anyway, I'll turn to you, Craig. What is the difference between worrying about the impact that individual customers might have and the benefit of that, as against expressing it in terms of the SDGs? Is that an advantage that's really more something that's internal for us, or is there the conclusion that if we can impact the SDGs, we'll automatically improve people's lives? What's sort of the lens that we can look through this?
Okay, so there's different ways of talking about this impact issue. And I think the conversation yesterday was, what impact does regulations have? So how does that impact insurers? How does it change the behavior of insurers to reach new markets, basically? That's a very different level of impact than what Anna's talking about, which is how are customers benefiting? Using the SDGs as a framework for analyzing the impact at the household level, I don't think it's a useful thing for donors, because donors are trying to achieve these goals. And so by demonstrating that insurance is contributing or not contributing to these indicators, I think is a valuable exercise. It's not necessarily an exercise that regulators would do. That's sort of probably beyond what regulators would want to be doing. But knowing that information is out there, and knowing the results could be useful in terms of saying to policymakers, look, what we're promoting, insurance, is having the benefits that donors and governments are trying to achieve. And so therefore we should have more insurance or better insurance. So I wouldn't see regulators getting into the business of conducting customer level impact studies. But I can see them wanting to have that information to be able to have conversations with policymakers to say, we need to improve our outreach, or we need to improve our products.
So it's useful also for organisations to say, well, when in conversations with donors, this is a good program that can help with advancing the SDGs. And probably also, if I paraphrase what you're saying, it'd be useful then for discussions within countries to say we should have an insurance development department in our supervisory agency or something like that. One of the other things we saw the progress in the Philippines, and I'm not sure whether you could even suggest that one of the co-authors of the Philippines impact study that you did could comment on this. But what we were hoping to do when we were doing our exercise was to say, well, here's all these projects we've done, which ones have perhaps made a difference. Maybe one of them was more impactful than another, and therefore we should do more of that. As I say, it wasn't very conclusive in our case, but you've got a long engagement through the ILO and also the network in the Philippines. If I had to put you on the spot and say, is there one or two things that have really made a big difference in the Philippines, what would you suggest they might be? Yeah, one thing you're not allowed to say is Arab going to live there.
I wasn't going to say that. So sort of getting to the topic of the impact of regulations, Anna was talking about the MBAs, and I think the whole process of creating that regulatory category and in requiring or formalizing the MBAs, I think is a big impact that's happened because there was a lot of informal insurance there that now is formalized and is under review process. And so I think that is a significant contribution. It sort of raises the question, under what circumstances does creating a special category for microinsurance make sense? And I think, I don't think we should be promoting the idea that we should have special categories for microinsurance everywhere, because I'm not convinced that it's necessarily the right solution. Certainly in the Philippines, I think it was the right solution because it enabled the formalization of a lot of informal insurance. But yesterday in the conversation regarding Pakistan, for example, they're creating a special category for microinsurance, but the people that they're expecting to then come into that category, the guests in the door, are largely MFIs and the MNOs who already are having insurance, but through a partner agent model with insurers. So is this going to be expanding the market or just moving the desk chairs on the, no, that's a bad metaphor. Is it just, moving who's carrying the risk for the same clients? Is it really going to expand the market to cover more people? Maybe it'll provide better service. Maybe it'll have better impact on client value, for example. And so maybe claims ratios will go up and servicing will improve. So there may be some value from the customer perspective. But from the outreach perspective, I'm not sure whether that's going to make a significant difference if most of the people that are likely to apply for licenses are already providing insurance underwritten by insurers.
Well, that raises an interesting question, and one that I'm going to just ask Jackie here about, because I think one of the challenges that I had in my mind, and I know you've heard this before, Jackie, so I'm just going to sit here and be friends with you about it, is that when you don't have a regulation or you don't have a formal situation or something like that, people are uncertain about what to do. And then when you do have formalisation and people come into the tent, say, it grows. It just fosters because it's legitimised simply by having something that says, now you're legal. And I'm wondering, what is the hope of actually bringing all these different societies into the legal network in South Africa? Do you really think it's going to blossom positively, or do you think you're going to close down a lot of shady schemes?
I mean, the informal operators?
Yes.
Okay. I think I'm very optimistic that the informal providers will come into the regulatory net. And I'm saying this because over the years, remember it took us so many years to be where we are with the microinsurance legislation. Over the years, we had discussion with them, and the issue was that they want to become part of the formal market, but the regulatory and compliance costs were too high. They could not come into the insurance regulatory space because it was quite too expensive for them to become insurers. Hence, one of the objectives of the microinsurance policy document at the time was to lower barriers to entry. So now that the door is open, there's a great interest in them coming. We are currently, together with the Prudential Authority, processing a few of those former informal players. However, not all of them will meet the requirements, but the regulatory framework in South Africa makes provision for them to become intermediaries as well.
So we'd expect that ultimately, if we go back to this customer impact, it's going to end up being a better result. Yeah, definitely. I like the word definitely. Brandon, I see you over there, and one thing that you had castigated me for as long as I can remember was that we shouldn't just concentrate on claims ratios as the measure of value. And so I'd like you just to refute what Craig Churchill was saying there about how that was such a good idea for a couple of minutes.
Would you like to sit down and be his friend?
No, that's all right. He can stand up.
Yeah, we can stand up. Well, so Craig and I here think...
The camera's right there.
Yeah, exactly. This Craig and I here think you're wrong. No, of course claims are incredibly important, but if 1,000 people buy a policy and one person has a claim, does that mean the other 999 people got nothing? No, of course not. They got the benefit of the protection, which allowed them to do other things with their time and money, and to take other risks. And so, obviously, if that one claim doesn't happen, and in fact it's tens of millions of people that buy a policy and there's still no claims, well, that's a little different. I think that the ex-ante benefit is the thing that we really need to measure, because that's the one that's going to change every policyholder's life, and that then goes to whether the customer understands what they bought, that they appreciate what they bought, and that they change their behavior as a result of having bought this policy, rather than just the people that have a claim.
So one of the things I think in terms of value, which was perhaps not necessarily coming through first of all, so Ching, and I'll give you another chance to tell us about what you've been doing, is that you had a range of different distribution channels. And it caused me to think, well, also there is an element of the value to the customer in terms of different ways that they might access products and perhaps different services that they'll get from those channels. And I'm wondering if you could just elaborate a little bit about what the experience was in terms of you've pushed this approach forward as the leader and from the Bank Negara point of view, and then you've said, why do we need to have a range of distribution channels when you don't have quite a big range of product?
Yep, because I think, statistically, I picked this up from the internet. By 2025, I think 75% of the global workforce will comprise millennials. So how will they buy insurance? How will they experience insurance? How will the baby boomers, who probably need the payouts around in 2025 or so, will experience insurance? So we believe that distribution channel is very important because it's going to determine how affordable insurance is going to be. It's going to determine how accessible is it, and the whole positive experience, hopefully, we feel they can get from it. So ultimately, can insurance one day be bought and not sold? That's the dream we have. And so when Brendan was talking about the measurement of impact, we're trying to move towards renewal rates, because if someone is willing, even though they have not made any claims, but willing to buy insurance again, and perhaps even buy a higher value amount, all through different channels, what kind of channels do they prefer? So that's the kind of behavior or information that we're hoping to capture, because then it means that we've changed the mindset, that actually they're going for something that they need, and they feel that even though they did not make a claim, but they saw their friends or family experience it, or they believe in it. And then ultimately when there is demand, then we feel that the market, the providers will be there. Example is we actually mandated the availability of direct channels for basic term life and medical products. So we said you must sell such products via a direct channel, walk-in or online, other than through the agency, force, and bancassurance. So when this policy was debated internally within the central bank, I clearly remember it was one of my first projects, and I was quite ignorant then, but Governor asked, should you mandate it if there's demand? Why do you need to mandate it? Why can't the insurers provide it themselves if there's demand? Is the market broken such that you need to mandate it? So, and then that time I argued that, yeah, the market's broken because clearly there's demand. Otherwise, but the providers are not there because the incentives are not aligned. It's too expensive through commissions and all that. 1 year down the road, governor then said, okay, I give you a time frame of 1 year, you can introduce that regulations, but we need to measure the impact. Is it actually effective? Is it successful? So I like that because that's also the beginning of regulators experimenting with regulations. It's not major, there's no systemic impact, I believe, but it could either do better or nothing. So we said, okay, we'll try it. So 1 year later, I think, I probably think that maybe we shouldn't have mandated it. maybe we should have worked with partners actually who wanted to, or maybe we should have used other ways. Example, other distribution channels, non-traditional, like non-conventional, like maybe post offices, agent banks with a huge agent banking network in Malaysia. I think local leaders who could do it better, perhaps, or even partnering maybe with the big techs or fintech companies who already have a distribution network that is already there. So that's.
Any other comments at this stage from participants, or will I ask another question and make another friend? Yes, we do have a couple. Okay then. I'll come back to you, Eric, because I'll do the ladies first thing here.
Yeah, a really simple question about something that you just mentioned, which is that you're looking at renewal ratios or renewals. How are you actually requiring insurers to report on renewal rates? Is that a regulatory reporting requirement? And what kind of information are you getting from that? And is it available in the public domain?
Not yet. We're just starting on it, but we'll be happy to share if we embark on it. But yes, we can do it via regulations. In fact, we don't need regulations because we have supervisors. So we can just ask our supervisors to request for such information. So it's kind of good to have all under the central bank, although we fight a lot internally, but it's also good when you need to collect data. We can actually do it informally, sampling even.
The tricky part with renewals as the indicator, I mean, it makes sense for voluntary products, but a lot of the microinsurance products are linked, mandatory, embedded, and people aren't buying the insurance for insurance sake. They're getting a loan, or they're putting money in a savings account, and they're getting insurance along with their cell phone minutes. So it's tricky to see renewals being the right indicator in general, but definitely for voluntary products.
With low levels of financial literacy, how are you sure that digital channels will fulfill the need in terms of providing the necessary advice which customers lack? So do you still see a role for an agent?
Yeah, I was talking to a conference of 2,000 agents, general insurance, and I had to tell them that they're still relevant. And I believe in that because clearly there's demand for face-to-face as well as not. But they need to go up the value chain. Their services needs to be more, to be better, And I think that's where they will hit. And some of them will likely fall out. But then again, digital, we discussed this quite a lot when we were talking about the National Protection Takaful scheme. Currently, it's the claims process is via the internet, online. But to the lower income group, internet is not the main access. But they do access the phones. Yeah, so one way or another, they will be able to make the claims. But I agree, it's slow. So part of the financial literacy agenda, we have just launched a literacy program strategy for the country, 5 years roadmap. And one of it is actually going to focus on insurance and also literacy through digital means. Having said that, that's awareness, as we all know, is a very tough agenda. But I can actually share that in where I work, we even go to the ground, and we have Bank Negara actually sponsors this what we call Carnival Kewangan, so finance fun fairs or carnivals, where we actually go down to more rural areas, and maybe it only touches a few thousand people at one go, but sometimes the attendance can be 10,000 or so. And I think it's a bit like the lottery idea, just making financial services seems fun, and it can be direct. And we make use of some of these to engage. But I think the question you had is the role for agents. I think they're still there, but they need to be more professional, and maybe they have to deal with other types of products that are more sophisticated. Yeah.
In those events, are there companies that are also there to actually make sales?
Yeah, so it's combination. It's awareness as well as we invite companies to come along. And so those Tenang products are being advertised there. And we sometimes use this opportunity to do surveys to understand whether people want to buy insurance, understand, or even want, So we partner with the insurers as well,
I think this is an interesting area where perhaps not as, like a lot of different jurisdictions have been doing different things. Some of them have been doing a lot of things in this area, and some of them have been doing a few. Everyone's got some kind of experience about how well those worked. It seems to be something that people think is a bit sort of localised to local customs and such, cultures, as to how best to communicate with people. But it would be really good. We could put this on the A2II agenda for the next 10 years to try and get together some comparative work on what works and what doesn't in terms of this insurance promotional role that supervisors have taken on, because this hasn't really been discussed very much elsewhere. But I think there's some great stuff being done. Often when I talk to insurance companies, they say the problem with low insurance take-up in our country is insurance awareness and financial literacy. And they seem to be of the view, and I think I probably was too when I was in that job, that if you're a marketing product manager in an insurance company, if people understand the product as well as you do, they'll buy it. And I don't think the goal is that everyone should become, have an encyclopedic knowledge of insurance products. And equally, if you do understand it as well as I do, you actually buy less. You buy it when you need it instead of when someone throws it at you, and so it becomes more in this terms of the responsibility thing, which is interesting. My brother, who's also an actuary, obviously wasn't paying attention at the right time, because when I insured my house in Australia, because it wasn't insured for a long time, my father got worried about it, so I insured it. And my brother asked me what the premium was, and I told him it was $900, and he said, but we're paying $2,400. And I said, well, what's the deductible? And of course they didn't know. Both he and his wife have done actuarial exams. So they went off and they got the paperwork out and found out, and their deductible was like $200 and mine was $5,000. And I said to him, so you're genuinely going to tell me you're going to make a claim for a $250 event? And he said, oh, probably not. So I said, well, why pay for it? But there's an example. Here's someone who has a bit more insurance literacy and buys less insurance, in a sense. And I think it's true. We are in the micro-insurance environment, we do sometimes face this challenge where we want to get insurance to people, but some of those people probably wouldn't choose to buy it. Maybe they wouldn't renew, to take Craig's point. I'll come back to you in a moment, Elias, but let's just, while we're still on this question of value, Anna, you've done this survey work, you've got this experience after a disaster. You've also looked at this question of are people getting value? And so I'd just like to again sort of get from you the take you had in your study of, first of all, how you looked at the question of value, and whether that value for the customer translated through to the SDG outcomes as well, getting back to this question of the linkage of the two.
Okay, well, so for value was very important in the work we did, because it's a type of microinsurance that is happening at the community level, and there is a lot of emphasis on the value and the benefits that people are getting regardless of payouts. So for that, we found the Sustainable Development Goals just provided the best framework to assess the type of value and community building and just substantial work that is happening on a weekly basis in these communities. So if so I have a slide with the summary and the next one, please. Yes, so those are the Sustainable Development Goals impacted in this particular work. So it's 10 of them. And we found, and actually we aligned them with existing metrics on insurance, so the financial KPIs and the social ones. So we haven't actually invented any metrics, so to say, but we have aligned, to simplify things, existing metrics to how they talk to each Sustainable Development Goal. So when we talk about fighting poverty and gender equality and education and social investment, actually each of those can be housed to a particular target that governments, all governments around the world have signed and have committed to. So this gives an indication of how microinsurance can support those existing targets of governments. So, for example, is in the specific results after Typhoon Haiyan, it was just very interesting talking about goal 4, for example, that is financial education, something that people in this type of microinsurance community programs get a lot of value out of. They meet on a weekly basis, they sing together, they pray, they pay their premium. In this case, they had a financial product credit attached to it. They also pay their loans, and they get a whole array of information on a weekly basis on building up their financial education, on sometimes health education, sometimes just information on new products, on what they need to do. Interestingly, in the results after the Haiyan, it was people who had people who had a payout and people who did not have a payout, but they were also part of the insurance system. So this was life insurance. So only people who lost the policyholder or a beneficiary had a payment. Most people actually did not have a payment, even if they were insured. So you can imagine value was hugely important in our work, to see how, if they still appreciated their insurance program, even not having any payout. What the most revealing piece of data is that both sets of people recover equally fast. The ones who had a payout and the ones who didn't. Because the ones who did have a payout, they were okay. They were able to they had money, the insurance money, to just immediately pay for starting to reconstruct their houses immediately, or just whatever other businesses mainly. People who did not have a payout, but they were part of this insurance program in connection with credit, they knew exactly what they had to do at the time of crisis. They knew how to access credit, where to go, how to pay for it, and it is the financial education that came out as just the most valuable piece of data, not only in our research, but in their lives. That's what they value the most, of being insured, that they knew how to react, even if they didn't get a payout. And in terms of the Sustainable Development Goals, just so before we move on, in connection with some of these comments, this is a bit of the chicken and the egg issue, and I don't think we should get the Sustainable Development Goals out of the regulatory conversation. One, because we would be going backwards. The IAIS has now put together the Sustainable Insurance Forum of regulators, specifically to support the Sustainable Development Goals. Governments, all governments around the world have signed targets to meet the Sustainable Development Goals and fight poverty. If we are serious about insurance being a mechanism to fight poverty, we need to work in the Sustainable Development Goals framework. The Sustainable Development Goals framework is just is currently the framework that dominates not only international development and donor programs, but also policy agendas at the national level. The insurance regulators, we work closely with them in this work at the Insurance Commission. They were completely aware of the Sustainable Development Goals. They were completely aligned to the national development plans that contribute and have taken insurance as a tool to help to meet poverty reduction targets. So regulators are a big part of this discussion, and in areas where there is not enough knowledge on what the impact is on the ground of certain products, in this case was the community-owned products. Again, it's just regulators, many regulators in this conversation say, well, we don't regulate, we don't supervise, because we don't exactly know the impact that this is having. It hasn't really been measured. We don't know if it's worth our time. Others say, yes, we know about the impact that this has, but we haven't got the technical means, or we haven't got the financial availability to develop the teams that we need to supervise those products. Well, that's what the Sustainable Development Goals framework does. That's exactly where this space to support those regulators is now there, and is now very much in the initiatives for all the way from the IAIS to government and insurance commissions in national financial departments, let alone we have Astrid here from leading the Insure Resilience Initiative. How powerful, 500 million people to be rich with insurance. What is the framework of that? What is the inspiration of that? The Sustainable Development Goals, regulators, we have to all work together on this. These are not separate agendas. They are all part of one big agenda.
Marvellous. Well, that's inspirational. I feel like we should go to the coffee break right now, but we still have time for more questions. But that's good to know, Brandon, that a whole group of people who never had an insurance claim really saw the value of that insurance. It reinforces that point. Now, Elias was going to make a comment, but it was suggested yesterday that he was one of the smartest people in the room, and that Kenya has been doing a great number of things in so many of these different areas, and so perhaps your question goes back to what we were talking about before with the whole education literacy thing, or perhaps it's about something totally unrelated. But I am going to invite you to stand up, because that man over there wants to be able to see you when you ask your question.
Right. Now, it's quite interesting when we discuss about inclusive insurance, and I actually get perplexed, because inclusive insurance, we not really need to use the normal indicators, the loss ratios, the renewal rates. It might not really work for inclusive insurance. And most of the time, if you look at the policies, the policies that we do create as regulators is about interaction and engagement between a customer and a provider. So if you look at inclusive insurance, it's all about how does a customer generate value in terms of the emotions, in terms of the relations, and in terms of the social value does the customer generate. So if we end up just computing a loss ratio, it might not really work for a customer in a village, because for him, when he buys this particular insurance, it's because of the social nature, the aspect that they have in that particular village. It's because of the relations that they develop. Most of the time, the risks that they take to the insurance providers, they've been using their relations in a village. So how then do we measure this relation? How do we measure the emotional aspect that they generate out of this particular product? How then do we measure the social impact that they generate? And that cannot be generally measured by the simple key indicators that we've been working on in the past. So for instance, if you get that an inclusive insurance product, you have had over 2 million farmers taking that particular product. But at the end of the day, these farmers have never gotten any value out of this. But for a provider, I will be happy and will go all over say that I've insured 2 million farmers. But out of those 2 million farmers, no one has ever claimed. So the provider will be very happy. For the customer, there's no relation or there's no exponential value out of that particular product. We really need to rethink about the data sets on inclusive insurance. We might not really use the normal ratios that we come across. We might not use the normal aspects that for a provider, if the loss ratio is low, the product is good. For a customer, if the loss ratio is low, he might not even think about that particular product because it doesn't really communicate to the value that he expected to generate. So how do we measure the emotional value? How do we measure the social value? How do we measure the relational value of an inclusive insurance product? So it's something that might really require new data sets. It might require all the providers and even the regulators to think about the key factors that really influence this particular product. So it's something that we might need to work on new data sets as regulators and also as the providers, so that the customer, we can measure that particular emotional value that they generate out of these particular products. For instance, maybe I can pick one example, is that once you develop what we call the consumer protection guidelines or something, market conduct, most of the time you'll expect the number of complaints that a regulator should go lower. But at times, you get more complaints coming in. Does it really mean that the product is wrong? Does it mean that the customer did not understand the product? So these are some of the issues that you cannot outrightly point out, but the only answer will be, how do we generate new data sets to get these insights through? And that's a big challenge that maybe we need to work together as teams to come up with these data sets.
So just quick reaction to that is a caution against creating additional reporting requirements for the microinsurance products. Because if you do that, then the insurers are going to say, this micro one is too hard, it's too complicated. They make me go through all these extra hoops in order to do the microinsurance, and therefore I'll just do the regular insurance, maybe for the same market, but I just won't brand it as microinsurance, and therefore will won't have to go through these extra hoops. And this was certainly came out from the research that we did in Peru. It wasn't about reporting as much as the first classification for microinsurance product that they created had enhanced consumer protection pieces built into it. So claims had to be paid within 10 days, for example. There was no exclusions allowed. And these were all designed to think, okay, this is a way to design a microinsurance product that will benefit people. But insurers said, oh, well, they didn't say it, but they just didn't act on that category. It was the way Henny was describing, that they built the door and nobody came in the door. Well, one company did, but they didn't last very long. And so then they had to completely rechange the requirements in order to have less distinction between the micro and the regular, so that more insurers would use that low-income category. But at the same time, they created this other category of mass, and that's where the insurers actually went into providing products in that mass category rather than the micro, because the micro still had these sort of extra hoops that insurers had to go through. So if you create, reporting for your micro that is different than from your traditional lines, it may create a disincentive for insurers to go into the micro space.
I know that Craig and I also had a lot of discussions about this over the years in terms of the mechanism for collecting data. And I think we can agree that from the conversation we've had, the sorts of metrics that we need to get to the bottom of impact is probably more of a range of measurements. The concept I suppose I have in my head is a bit of a dashboard of lots of elements that go together to contribute to this. But also I think there are different ways we can collect things. And historically, for supervisors, we tend to collect things in terms of annual and monthly and quarterly returns and things like that. And I think it's probably worthwhile asking us sometimes, do we really need to know with tremendous precision exactly how many people did something every month? Are we going to change our behaviour and do something about it from this month to next month? Or are there other ways that we can do that? So, for example, the number of people who have insurance policies, the financial inclusion people in banking work out how many people have bank accounts, like the bank accounts per adult. They take the number of bank accounts, they divide it by the number of adults. They don't make any adjustment for the fact that some people have more than one and some of them are owned by governments and corporations and things like that. That's just the number. We, on the other hand, get hung up about, well, is this person got two policies? Is that a group policy? Is that a business policy? We need to analyse all of that. So as a result of that, we don't collect anything. And that makes it difficult. But it's possible that we could survey a group of people and say, do you have an insurance policy? And then we'll know how many people at least think they have one. And with that information, we can go and continue our life doing whatever we want to do in our insurance development department and such, and then come back and see whether it's changed in another year or two. We don't need to know every week whether that number changes. So it doesn't need to be part of the monthly reports or whatever it might be in that sense. And I think there's a lot we can do in terms of using survey analysis, which could get us a long way. Now, I don't know, Tim, do you know much about what Rafe Mazer was doing on the survey work? I'll tell people about it then very quickly. So this is a colleague of ours at CGAP, got involved in actually doing surveys in the area of mobile phone insurance, and particularly about what the customer experience was and their element of understanding and appreciation and such about it. And you can do that very easily because, of course, these people have mobile phones, so you can call them up. And so he was able to put in place a very cost-effective little program that did that, and then also was able to make real-time changes in terms of how disclosure and communication was done to customers, and then retest it again. And all of that was done much more efficiently than we as regulators would, in our traditional method, say, let's redesign the whole thing, have a new regulation, get everyone to reprint all their forms and procedures and then do it. And then we can't change it again for another however long. So I think we can be a bit flexible about how we collect things as well.
Thanks, Craig. I'd just like to add, if we look at microinsurance, we are looking at a low-risk product, much lower than before. If we're looking at regulations and the like, we should be heading down to how much less regulation can we do for this product to interest the insurance companies? How much less capital do we need? How much can we lower the requirements of agents or whoever it is to sell the products, and so on? To start adding to the requirements, okay, it might be a fascinating way of collecting other information, and I agree that a claims ratio isn't as relevant for microinsurance. But by and large, the collection of information is an interesting exercise, and there might be a way we can do that and get more that way. But unless we as regulators are really interested in lowering the requirements as far as possible, and where you go from there is up to each and every regulator, of course, then I don't think we're heading in the right direction and making it very attractive for insurance companies.
Shall we take that as a comment?
I think that's what I was trying to say, but he said it much more eloquently.
Yes. Any other questions or observations? Yes, while you're intervening, I'll walk down the back to another of my friends with the microphone.
Sorry, I can
Yes,
respond.
yes.
Okay, sorry. I was just saying. I used to be in macroprudential regulations, and everybody asks, are macroprudential regulations effective? And so I totally understand. So there are some central banks that does models on this. There are some central banks that doesn't. So, to me, at the end of the day, we don't need to collect more data through formal means. I think when I was saying through supervisors and sampling, yes, I totally agree that a lot of times it's just about talking to these people. And as what Craig is saying, that you just need to have a sense of where things are going, and the feedback from the people who are involved in it would be fine. We don't need to run a regression or big data analysis. Maybe big data could be explored, so which is something that is outside of regulatory reporting, but something that regulators, if you're equipped with it into data analytics and so forth, can actually draw. Example, web scraping. What is the respond of consumers to a certain program that you have introduced, or what is the response of certain consumers to a certain like Tenang or My Salam product? And central banks or regulators, if you are open to it, can build some internal capacity in such areas, and doesn't have to increase regulatory reporting burden. I do agree.
So Mia, you've got a point to make on this data collection issue, or what kind of data we should collect, or something like that?
Thanks. So, thanks, Craig. So I think there's two levels of the discussion here for me. The one is around the role of regulation to contribute to things like the SDGs and the outcomes that we want to see in society, and the role that insurance should play. And then there's a question around what we should be monitoring as regulators in terms of what we control and the value of the products that we're developing and delivering to contribute to people's lives. And I think finding that ideal set of indicators that are low impact on the providers, but still give you that sense of where the market's at is really what we should be focusing on. And I think there is a question on the one hand of value and how we understand value. But I think what really struck me when we did a recent series of insurance diagnostics in Africa is also just how problematic certain actors in the market are and how that impacts trust. And I think that ends up adding a lot of cost to the innovators in the market that want to try and sell useful products to people, where if the perception in the market is I can't claim, or it's very difficult. And I think kind of identifying those indicators, those critical indicators to monitor, and then the sanction on how you kick some people out of your house that are quite rowdy. You don't just want the guests at the door, you also want to figure that out. I think those indicators are also things that kind of we should really be looking at. But I think if we look at outcomes, for example, what's the role that we should be, how do we think about health outcomes, how do we think about agricultural outcomes? Those are not things that insurers can do on their own. And one of the things I've been thinking about is how do we measure the quality of coordination that we've got between different sectors in government to figure out how insurance can contribute to those outcomes? Some of those indicators are policy level indicators. They're not necessarily insurance regulator indicators. But we often have quite a crisis of coordination. And I think there's something that we need to be measuring to hold departments accountable to work together. Barriers in insurance are based often in payments. They're often based in credit markets and health. So I think that's also an interesting question for me, how you think about that coordination component for outcomes. Thanks, Craig.
Yes, and one of the interesting things, Mia, I think, which just to elaborate, because it might not have been so clear to everyone, is that when you talk about how the bad actors in the room, when we think about inclusive insurance, don't tend to think a lot about motor insurance. We tend to think that richer people own cars. But Michael McCord and I did an exercise, a study of the concerns that people have in terms of insurable issues in Ethiopia, and amongst urban Ethiopians in particular, one of the highest risks was being hit by an uninsured driver. So the functioning of the motor insurance market was very critical to the reputation of the insurance industry. for people that walk along the street, not just for people that drive along the street. And so the behaviour of getting that to work was really quite important. So it's just interesting to see how the whole mechanism comes together to make it work, not just one part of it. That was interesting, wasn't it, Michael? We learned a lot about what Ethiopians think, which is not the same as what everyone else thinks as it happens. So it's always good to ask the customer. How are we going for time? 5 more minutes. That means we've probably got time for, one more. Well, you've had one shot. Is there anyone else who wants to have a go? Look, they're being nice to you. So I'll come round with the microphone again. And we could say final questions and observations.
I don't know if this is a question or an observation, but I'll start with the observation that it's really nice to think about adding questions or reporting requirements that relate to value and claims ratios. But the reality is that for many of the countries, don't actually collect data around how many lives are covered, whether it's the number of policies. And we know this from first-hand experience. Both Michael and I have worked on this. There's probably others. Hannah has been working on this from the regulatory side. It may be that the regulators in the room are exemplary and exceptional, but our experience in doing the data collection for the landscape studies has been that it is incredibly difficult to get that data, and the regulators that collect data about the low-income people that are served are very, very few and far between. And getting the answers from industry is really like pushing water uphill. So I think maybe it would be good to, just take a step back into reality here without meaning to be disrespectful, but to say there are these very, very basic indicators that we need, for which we need information about the number of people that are actually being helped, working on the assumption that they are being helped by whatever is out there. Alongside which, yes, we need to do demand-side studies. We need to do studies that look at the value of the insurance products and services on offer. But that very first step is one that we're still busy taking. And what I would really like to see is regulators around the world collecting that as a matter of course based on income group, income distribution. It's done for credit. I don't see why it can't be done for insurance. And yes, I recognize that might take 10 years, but that 10-year journey starts with the first step. So any comments on that or suggestions or ideas?
Any comments or suggestions or ideas?
Speaking on the part of the people who will generate these data that will be required, I think it is challenging enough to push insurance to the low-income sector. As we all say time and again in every conference, nobody wakes up saying, I must buy insurance. Nobody. It's tough enough to do that, and it's challenging enough to comply with all the regulations that come in about KYC, I talked about this yesterday, anti-money laundering, and data privacy. So the amount of data to gather. The reality is that we all want, most of the industry do want to do good. They do want to collect data. They don't have enough, they're not equipped enough, they're not agile enough, because to do so, I mean, there's a lot of effort that goes into data gathering and then analysis. And so insofar as I'm concerned, as Catherine mentioned, we really all should just go initially with the basics. What is wrong with tracking premiums? The industry survives on that. What is wrong with tracking number of lives, number of policies, number of enrollments? That actually does give us a basis for how, for the penetration rate, for the effectiveness of some of the campaigns, initially. If you don't track how many people have bought, then how do you know how many people will stand to gain and benefit from it in the event of a calamity, in the event of some loss? We need that to get started. I think emotions aside, How do you capture so much emotions, and how do you translate these to your legislation, to the government, to the legislators, and say, hey, we must push more of this? You know, 3 other people felt really good about it and are really happy. How do you make sure that this does not become anecdotal? There is a reason why the industry has always requested and required measurements about renewals and lives and policies. Let's stick with that for the beginning. And let's work together and make sure for legislators require that from us. And then we will exert effort to track that. And once we have that info, imagine the wealth of data in our hands that we can all work with.
Thank you. And I think I'm 5 minutes up? Yes. So I'll make one final observation before thanking my panellists. Yes, I agree that probably there's a lot that we can do with what we already have. There's a lot of information also that is not collected by the insurance industry. You made that point, I think, with big data, that there's other information out there that we probably don't make use of either. And we're all of the view that we need to get a better picture. So it's not necessarily an easy problem, but we've been talking about this problem for a long time, I think. So maybe we need to just do something about it.
I might just quickly come in here to say, because this has actually been very useful, I think, this discussion here for the A2II. We have a project we're doing with sub-Saharan African supervisors on developing a data reporting template. And it's exactly what we've been talking about now, trying to develop something that would have fairly basic, so it can actually be implemented, but still be able to sort of look at consumer value. So not just looking at ratios that don't provide that sort of information, but I think also something that would be practical and pragmatic for the industry to be able to collect the data on. So this is an ongoing project that we have. Actually, I think we're also working with SEMFRI and we've brought together a working group of different supervisors from across sub-Saharan Africa to help sort of give us their feedback as well. But I can also see we need to turn this to the industry, is also what I'm taking out of this, before we go too far, should we say, with the project. So no, this has been very helpful.
There's one other challenge, though, with the whole question of measuring things. Are we on? Yes, we're on this one. One of the other challenges of measuring things, which I think is probably ripe for another session, is just exactly who is developing the insurance sector and what their mandate is from the side of the government. When we did the original case studies and work, some of which were referred to yesterday, one of the conclusions, I think the first one, was that if there isn't a government policy leader, a champion, then things don't make much progress. This is something my friend Henny taught me the first time we had breakfast together. So having that champion and that leader is kind of critical, some sort of like national point of which people are gathering around. But it's also a question of what mandate that has. And in some jurisdictions, there is a development mandate for the regulator, but that development mandate is exactly what I just said, and nothing more. They say, we've got a national development policy, we want to develop the financial sector, within that we want to have more insurance, we have an insurance supervisor, you do development. And that person has very limited scope for all of the range of things that may be relevant to develop the insurance sector. So the one thing they do have control over is premium to GDP. So then it gets bigger. But bigger is not always better. And so we need to have this sort of whole idea that we're measuring the right things so that it's not just about bigger. Because if the solution was develop the insurance sector, that means it's time. If the solution was to develop the insurance sector for it to be bigger, then the answer would be make more things compulsory. And quite often, when you ask in many of the markets I visit, go and see the insurance industry, what should we do to develop the insurance sector? They say, make this compulsory. In that country, they have this compulsory. We should have that too. And then we end up with a nice insurance sector that can't sell an insurance product at all because the government has just mandated it. So we don't want to go down that route. So I think this has been a really worthwhile discussion. It's been tremendously varied in terms of the the ranges of input, but also centering around those interesting topics of, what are we trying to do, why are we trying to do it, and how do we know if it makes a difference? And obviously we've got a long way to go, but we're all thinking about the right things. If you could thank my esteemed panellists. And back to you.
Thank you very much. Wow, that was a fantastic panel with a lot of food for thought and a lot of energy and passion in the room. And I think the discussion really showed that there's a lot more work that's needed on the topic. And as Hannah said, that's something that we're looking at doing with many of you in the room. So thank you very much also from my side. Now, before we break for coffee, I want to get back to the breakout sessions that we voted on yesterday and give you a bit more information on that. Because we'll meet directly after the coffee break, we'll meet directly in the breakout groups. So at 11:10 is when we start. So we have the 4 groups that you voted on yesterday. And even if you didn't get the one that you would have liked to have, we hope that you're still happy to join one of the other ones, because I'm sure the discussions will be really interesting. So could I please ask the facilitators to come up front so that you can see them, I can introduce you, and that you know who to go to. Regina, you're also one of them. Thank you. Okay, so my dear colleagues, we'll start with maybe with Regina, and she will lead the group on SME insurance, and that will be in this room. So anyone wanting to discuss SME insurance, please meet in this room at 11:10. Then Teresa will lead the group on bridging the protection gap in climate risk insurance. And that will be, first of all, sorry, could I get a quick show of hands of who is planning to join the SME group? Okay, perfect. Then who is planning to join the climate risk insurance one? Okay, perfect. So you will meet on the terrace in that corner. There will be some chairs later after the coffee break. So then Janina will lead the group on monitoring the market. Could you? Okay. Actually, let me switch that around. The climate risk people will be over on that part of the terrace. So this terrace, but around the corner. And the monitoring the market people will be in that area. And then we have the digitization and insurtech group. That's everyone else, I guess. And you will meet in the breakout room that's sort of behind where we had lunch. There's a second room with some chairs and tables, and that's where you will meet. Although I'm thinking, sorry, I'm switching everything around again. So Regina will meet in that room, and you will meet in this room because there are more chairs here. So digitization, forget everything I said. Digitization is here. I'm repeating now. Digitization here. SME insurance in the breakout room behind lunch. Climate change on the terrace behind us, and monitoring the market on that part of the terrace. Great. So the moderators, facilitators will give you a bit more information of what exactly you will be discussing and how during the breakout groups. But just so that you know, you're expected to come up with concrete recommendations for supervisors. So this is a very sort of action-oriented session, and we want some results, which afterwards will be discussed in the plenary. So you need to make sure that your recommendations are better than the others. So I'm just putting a bit of pressure. You have until 12:45 then to discuss, and after that we will go directly for lunch and reconvene here for the plenary at 1:45. So coffee break now, then at 11:10 breakout groups until 12:45, and then lunch. So with that, enjoy your coffee break.